Thanks, Brian. Good afternoon, everybody. And I guess we're calling this meeting to order at 4:02. And let's see what we've got for our agenda. We're starting with the minutes from the prior meeting, I believe. Open up my deck here.
If there's any public comments, we could check that, and then we'll go to the meeting minutes from last month.
Yep, so let's see. Do we have anyone from the public on who would like to make a comment? And any members of the public who would like to make a comment? Okay, hearing none. Move over to our consent agenda item, which I think is, yep, the meeting minutes. Were there any comments or questions on the minutes from our meeting just about a month ago? Haven't heard any. So can we get a motion to approve our minutes of the November 13 meeting?
So moved. This is Kevin.
Second,
Okay, and who is the second?
Matt, second.
Matt? Okay, thanks, Matt. All right, any discussion? All right, all in favor?
Aye.
Aye. Any opposed? Any abstentions? Carries unanimous. All right, so I think if I recall our last meeting, we went through a series of CPACE projects, one of which we had a very robust conversation around project in Branford, and I think we were going to go back and look at that proposal again. So who's going to take us through that project?
That'll be me, Catherine Duncan.
All right, take it away, Catherine.
Okay, so yeah, we have seen this project before, and none of the particulars of the project have changed since last month. It's a mixed-use property. They're installing solar. Next slide, please. It's a 20-year repayment period. The interest rate is 5.75, and the benefit assessment is close to $900,000. You can see the LTV is 62.9%, lien to value 19, and there's a healthy DSCR. The mortgage lender is Essex Savings Bank, and they intend to consent. And then you can see the SIR is above 1. And if we could move to the next slide, we get to the point where we had the discussion last time round. So this project has a negative, unsculpted. This repayment schedule has a negative annual SIR. This is the sculpted version. So since the last meeting, this is the key change. The owner received all 4, he's got 4 projects that are coming through the Green Bank right now, and he has now seen all 4 sculpted amortization schedules and has decided to sculpt 3 of the 4 projects. So this is the new cash flow that you did not see last cycle, or last month rather, and you can see that the annual SIR, except for year 2 and year 11, which is when we anticipate the replacement of inverters. All the other years are cash flow positive. And then if we go to the next slide, this was the original unsculpted amortization schedule that you saw. So in accordance with our new process, we will show all sculpted amortization schedules before we bring projects for approval, and we'll include both cash flows in our slide presentation. So does anyone have any questions or comments?
I'll comment and just say thank you. I really appreciate the extra effort to go back and show him this stuff, the sculpted versions. I shouldn't say this stuff. I know we spent a lot of time on it, so I won't belabor it, but I do appreciate that. And I just think as a committee, it's something for us to keep an eye on. Again, as I think staff pointed out, very capably, doing it either way complies with our rules. There's no right way here. But you know, just the long term, looking down the road, I'm more comfortable when we see it all like this. So I appreciate it. Thank you.
You're welcome. So if there are no other questions or comments, we could move to the resolutions.
I guess I would just add, Matt, I was reflecting after the meeting. I didn't have much context for the conversation last month. And in having a brief chat with Brian earlier today, what I suggested, and I think the Green Bank is taking into consideration, as to whether we can periodically see reports of where we have borrowers who are choosing these unsculpted cash flows, so that we can just get a sense for whether it's getting out of balance, or we're seeing very large shares of borrowers are taking this. My sense is that this is not that common, and it's mostly when there's a roof replacement that occurs with the solar installation. But just, periodically looking at the portfolio to see just, how frequently this is happening, I think would be helpful for us as a committee.
Yeah, thank you for that, Joe. So taking that, Matt, we were thinking the annual comprehensive financial report where we do the non-financial statistics section and we have a CPAY section. We'd work with the team to figure out how to present, these types of transactions from the norm over time so that we can kind of track and see them, and take note of them.
Yeah,
So great.
I appreciate that too. And I'll just put my thumb on the scale a little bit in case my view wasn't clear from the last meeting. I would think at some point, once we get that data, it would be good for the committee to have a discussion of whether we want to put our thumb on the scale in favor of sculpted as a programmatic macro issue. Not each individual owner certainly can make the choices, but we're in charge of the program. And, I just think long term, having the upside down numbers at the end is not going to be a positive view for the project. So for another day, but maybe once we get the data, that's where I'm coming from.
Okay, are we ready to go to the resolution?
I'll move passage of the resolution as written.
A second?
I'll second it.
Okay, I'm sorry, who was that?
Allison, and I don't know who the
Allison.
other person, yeah.
Okay. Any more discussion? All in favor?
Aye.
Aye. Any opposed? Any abstentions? Unanimous, okay. And next we have a program update, multifamily affordable housing update. Who's going to take us through this?
Great, this is Mackie. I'll start and then I'm going to pass it over to Emily Basham. Go to the next slide. So a few board meetings ago, Matt had asked for this committee to regularly get updated on where we are in terms of deploying solar and storage in the affordable multifamily sector. We started work years ago on trying to achieve higher deployment in this sector, starting with the statutory work, partnering with DEEP and getting a statutory change, and have been making our way through a lot of work to actually get to the project deployment stage. And we started setting goals for ourselves. I think last year might have been the first time, but weren't at the board level, you weren't seeing projects closing towards those goals. So rightly so, I think Matt and maybe some others would say, well, let's dig into that a little bit, see what's going on. So we've run out of time for several deployment committee meetings. But we'll finally be able to get into it here. So what we were going to do for the first one was provide the policy overview that I alluded to. We started work on a few years ago, and then talk through the program we've built to deploy solar and storage in the sector, and then the financing product we built to go along with that, and then get into pipeline and how we're doing. Next slide. So again, this started with work with Deep years ago, where we made a simple statutory change, which has led to really this market opportunity blossoming, which was to have affordable multifamily deemed, at least for the purposes of the state and solar incentive programs, residential as opposed to non-residential. And we also wrote into that statute that there could be one project to benefit all of the demand on site, but the benefits from that one project had to be shared with the tenants. So that, like I said, really opened up the sector for a number of reasons. One is just that the residential incentive is higher than the commercial incentive, which these projects previously were eligible for, and that commercial tariff or incentive is also competitive. It's a reverse auction. So when you've got multifamily projects, which tend to be smaller, and the development is just a little tougher. It's not as straightforward as putting solar on a flat warehouse or big box store, something like that. So when you're competing against projects like that, they just weren't winning out. So you didn't see a lot of deployment. And then the majority of these sites have multiple meters. The tenants have their own meters, and then you've got the common area meters. So by allowing the load to be grouped together for one project, as opposed to having to do individual solar projects behind each of the tenant meters, it made the development just much simpler. I'm sorry, I'm seeing this whiteboard. I assume, Catherine, it looks like you might have hit a button to share a whiteboard. If you'll turn that off once you get the chance. Thank you. It really just made the development a lot easier. So you've got higher incentive and the ability to build one solar project to benefit all of the meters on site, and then you share some of the benefits with the tenant. So it just created a much more ripe development opportunity in the space, which it took we had to get the legislative change in place, and then a year or two working with PURA to get the the regulatory framework in place for this, which then we saw finally the RRES program that the utilities administer. We saw that set up and accepting applications this year. Next slide. As I mentioned, one of the key, so all that's great, but our goal was, if we're gonna get these projects done, we want to make sure that those that need the benefits the most, the low and moderate income tenants, see some benefit from the project. So in the case of where they have their own electric meters, that's fairly straightforward. They have to get at least 20% of the overall tariff distributed evenly amongst all the tenants, and that's done as a credit on the electric bill. The utilities just, they're buying all the electricity, they know how much is produced, they then place all those credits across all of the electric bills of the tenants. When it's master metered, so in that case, you've got one meter for the entire property, which is composed of all the individual tenant units, as well as all the common space. It's a little tougher to get the financial benefit directly to the tenant, because they don't have an electric bill. There's no direct relationship between the utility and the tenant. We explored a lot of different avenues to get the benefit to them. We being PURA, as well as a working group that they assembled that we're on, along with DEEP and the Department of Housing and CHAFA. And for a number of reasons, where we landed was an upgrade that was made to the building using the tenant's portion of the tariff. And you see here a list of what those upgrades can be. You're also the landlord is also allowed to provide ongoing services. So You can do, like I said, a one-time upgrade funded from the value of the tenant's portion of electricity. It can be battery storage, energy efficiency measures, any sort of, one-time capital improvement, or they can use the ongoing tenant revenue to provide ongoing service such as job training, mental health services, or something like that to the tenants. Next slide. So that's the new policy and incentive framework that we're operating within. I'm going to turn it over to Emily to talk about the program that we developed and the financing product we developed to actually deploy projects within that framework.
Thanks, Mackie. Good afternoon, Deployment Committee. I'm Emily Basham. I'm an Associate Director on Mackie's team, managing the Solar Marketplace Assistance Program, or as we call it, Solar MAP. This is the program we're using to support affordable multifamily project development. And it's a turnkey program. We offer no-cost technical assistance, project feasibility and development, and also our green bank financing. So this is just a quick overview of the program. Our team works with the property owners to identify sites that meet the definition of affordable multifamily and would be a good candidate for solar and storage. We provide a two-step feasibility analysis with our technical partners for the program to find options for roof, ground, or carport installations. We then develop a preliminary project concept that includes a design layout and project economics. We present that to the property owner. And once they confirm interest, we provide a proposal for a site lease, which we'll go into in a couple slides here. We work with the property owner and various investors and equity stakeholders to understand the program and the benefits and get project approval. And then we execute a site lease for the project or loan. A key element of the Solar Map program is that the Green Bank is aggregating projects into groups based on similar development timelines, and we put them out for bid for a solar installer or an EPC. This key feature allows us to achieve economies of scale and competitive pricing that we can bring to this project type. And then once we are executing that EPC agreement, we construct the projects and deliver those energy benefits to the property and the tenant. So that's a quick overview of the program. And if we can go to the next slide, I'll give a quick overview of our solar lease. Thank you. So our solar lease is really the best fit for affordable multifamily properties because these properties are typically debt constrained and they can't provide the capital outlay or take on additional debt for a purchase option. So the solar lease is really a bit of a misnomer called a site lease, but it's really a revenue share agreement where we're splitting the project revenues between Connecticut Green Bank as the system owner, the property owner, and the tenants. Green Bank owns and maintains the asset and bears the risk. There's, as I mentioned, no capital required from the property owner. And we're able to deliver those tenant benefits that Mackie mentioned was critical to the policy goals here, either through an on-bill credit in their electric bill, if it's individually metered, or a building upgrade from that list that Mackie ran through as part of the project.
And I'll just add we haven't, as we'll talk about in the portfolio coming up, it's all solar right now, but we can integrate battery storage into this lease as well, where we own the battery and provide that resiliency benefit. for the few projects that we've modeled, it's the solar sort of had to carry the storage on its back economically. The incentives and revenue from the battery have been a sort of net negative on the economics. So the solar has, like I said, it sort of carried along, and the solar revenue has been able to subsidize the battery. We're hoping with some of the solar for all money that we've gotten, we could at least make it neutral to integrate that battery and improve the attractiveness of those. So we hope to start to see batteries in some of our future projects.
Mackie, just a quick follow-up on that. Is the battery considered a tenant and improvement? Is that the cost of that a benefit for the tenants?
If the property's master metered, then yes, the tenant portion can be used for the battery. So that's it. We went right to one of the key benefits, or sort of product, product benefits there is for master meter properties, we're kind of pushing batteries because that's essentially another incentive that you have for those, right? So yeah, we're really hoping to focus on master metering.
Mackie, quick question on that vein. What about health and safety upgrades like lead pipes and asbestos? Is that a tenant benefit that they can use the 25% toward?
I don't believe so.
Yeah, I don't think it's on the list.
We're hoping, I think, Emily, that was on the list though of some of the, one, we tried to get some, we partnered with a bunch of the COGs and put in an EPA application to try to get some grant funding to deal with that, as well as, like, some of the barriers, roofs, health and safety, things like that, but didn't win.
But they can finance that as part of the overall project still, right? They can still bake that into the overall project.
Yep.
Okay.
All right, so I'll run through our round one portfolio of projects. As Mikey mentioned, these are solar only projects for now. Our first pipeline of projects, our first group of projects here on the screen are 9 projects. They're ranging from 93 kilowatts in size to about 400 kilowatts. The total portfolio is 2 megawatts. And we're anticipating the project value to be about $6.2 million to build these projects, kind of sprinkled across the state, really in the middle belt between Cheshire, Hamden, Tolland, New Haven, Hartford, Storrs area. You can see on here the number of units that the site is serving and the combined benefit that the solar project will provide the tenant and the property owner. This is based on a 30% ITC assumption that we could capture for the project. And if you go to the next slide, it's the same pipeline of projects, just some different rows of information here. We are able to capture some of the ITC bonus adders available through the IRA. So we've marked here which ones are eligible for energy communities versus low income communities bonus, and those will be additive to the cumulative benefit that we could bring to the property. So it would be in addition to the values on the previous slide as well. This portfolio, we are happy to announce, has just been released. An RFP has been released for this portfolio last week. So this is for EPC partners to build these projects. That's the next step of project development needed here for this portfolio. In that RFP, we are asking for project versions and solicitations that include our GGRF funding. So we're looking forward to potentially bringing those funds into the portfolio. And this is our next round of projects. These are at an earlier stage of project development. So you'll see sort of a wider net here of 14 projects, almost 3 megawatts, $9.1 million worth of projects. So we'll see a couple of these potentially fall out, some being added for our next portfolio. Here we would anticipate releasing the RFP for EPC services for this portfolio in about Q2 of 2025. So we got a really healthy second portfolio. Have to give credit to team member Katie Shelton, who's been hard at work developing this pipeline and a backup pipeline as well. So really great progress here. And then lastly, I think the last slide we had prepared for the group is really just some feedback and some insights to the work that's happened over the last year to build this, build the market out and build the pipeline. Mackie mentioned the legislative and regulatory changes that were required to really initiate the opportunity here. And while it's really opened up massive opportunity for affordable multifamily projects, there's also an education gap that the Green Bank is really working hard to be a leader in filling between property owners and contractors. Some folks in the contractor industry don't know that these projects are eligible for RRES and therefore unlock a different design as well as different project economics that can make these opportunities more attractive. So we've really taken a lead role in doing webinars and attending conferences and presentations to really spread the word about this opportunity. We're working with property owners directly through the MAP program and also through our contractor channel, helping contractors figure out the nuances to developing projects in this space so that they can move projects forward and use our financing. Next is what Mackie mentioned. We've had some of the individual versus master metered nuances of the program still evolving. We just received the kind of finalized rules for how the metering would be treated in the RRES program this summer. So we've been really thoughtful about how to incorporate that into our financing products, but also into our program process, sort of midstream. So we've really been evolving our resources as the program's been evolving. And the program requirements that the tenant benefits be shared with the tenants is specific to the Connecticut program. And so some of the investors or equity holders for affordable multifamily could be regional or federal. And so really helping them view that tenant benefit not as income has also been a learning curve that we've taken on in the program. Some funders like HUD or TRAFA or some requirements with LIHTC investors. Any income to the property kind of triggers different approvals for their funding streams. So we've had to really engage with various partners or investors on a property to make sure that that benefit in the program is delivered to the tenant and isn't sort of backed out with any like utility credits or allowances in programs. So we've worked with HUD to provide national guidance so that it's not impacting their utility allowance calculations. We've also had some conversations with LIHTC investors reviewing properties on a case-by-case basis just to, you know, keep in place all of the benefits that are coming to a site if they go solar. And lastly, just want to point out the contracting work that the team has had to do. We require really a good collection of governance documents and wet signatures for recording this type of financing arrangement. So it's not a light lift for property owners. They've got a lot of different stakeholders involved in their properties to get approval for any type of solar project. And we've developed a great working relationship with our partners at Chaffa and HUD to develop review checklists and technical checklists to help streamline and make this lift a lot lighter for our property owners. So a lot of great work is being done at Green Bank and our partners to really help open up this market for the long run. So a lot of great work. And with that, that's I think that's the end of our slides.
Excellent. That's quite helpful. If I could take the lead with one or two questions, what is the breadth of the audience for this? Is it, when you say affordable, is there a income threshold for the properties, and multifamily, is that 5 units and above, or what qualifies?
Yep, you're exactly right. Affordable multifamily is a defined term legislatively and in the program rules, and it's 5 units or above and has to meet the income qualifications. There are a number of tiers for qualifying for affordable multifamily, which are published through the program. I think there's 3 tiers. The first tier is the first and second tier have published lists of sites that are available and updated quarterly. And then there are some pathways if you're not on those lists to achieve eligibility through a working group. So there is a strict definition to be affordable multifamily, and I think that's probably the first hoop that you have to jump through is determining if a property is qualifies for being affordable multifamily or not, and something that is sort of, inside baseball information and requires this sort of like support and development to know if there is an opportunity.
Yeah, there's a statutory definition, which, it's a certain percentage of units that are set aside for tenants at a certain percentage income of area median income. But then authority was also given to PURA to come up with other definitions of affordability. And the working group that we were a part of, and the recommendation we put in, very focused on, let's piggyback on existing housing affordability programs rather than have solar developers going out and doing income verification of all the tenants to get the properties to qualify. So that's the list that Emily was alluding to. Working with the housing agencies, we said, okay, here's all the programs that line up with their housing, with their affordability requirements with the statutory and 1 or 2 other certain percentage of units and certain percentage of income that Pura laid out. So if you participate in those programs, then you should be eligible. And we have quarterly DOH, HUD, and Chaffa pull the new list together of all the properties participated in their programs, so that, again, you're not having to qualify them in again. We're just using their subsidy programs to find them. And then there is, as Emily said, there's another route for naturally occurring affordable housing, meaning you're not subsidized, and that's based on rent levels and how they align with HUD affordability requirements.
Great. Other questions?
Well, it's Matt. So comment and question. First of all, the program pipeline is amazing. I think, Mackie, you could probably provide some perspective, but I think we had years where we just couldn't, I know staff has spent over a decade trying to crack this nut. Honestly, the number of hours you guys spend is amazing, learning and it's a hard one. And to see this many projects in the pipeline, it's really nothing short of amazing in an area that we have just been unable to get traction. So huge kudos for everyone for sticking with it in such an important area, because we work with ratepayer money and we weren't able to get benefits to a whole class of people that we can now get benefits to. So I can't overstate how impressive this is. And then just the question is really sort of a question and an offer about outreach. I know that that's probably next, and I just had some thoughts on other outreach avenues, and I'd be happy to share them with Mackie or Emily offline, just rather than go through them. But I know DCD has this new municipal redevelopment authority that David Corus is holding up that's charged with housing. It's not necessarily affordable housing, but I had talked to him recently about carrots and sticks, and maybe as a carrot, this could be something he could offer up whole cloth to projects so to encourage them to do affordable components, because that's not really his job. There's open communities, Partnership for Strong Communities, the Bar Association Planning and Zoning Committee, CCM. I'd be happy to assist with contacts in any of those places. So if you want to talk offline, let me know.
Yeah, that would be great. Thank you for offering that.
Yeah. And staff should take a victory lap for this. Really amazing.
I will certainly be
Yes.
passing this on to the team.
Yeah, it took us longer than we thought to actually get to close projects, which is, I was happy when you asked for this map because y'all were just seeing those zeros on the progress to targets. But it was for every 3 steps forward, it was 2, sometimes 3, sometimes 4 steps back with some of this building to market issues that Emily outlined. So
Yeah, we shouldn't measure ourselves just by the markets that are easy to penetrate.
Yeah.
I think this is a better representation of what staff can do than the ones where the market takes care of some of the work.
Yeah, Emily and team have really done amazing work here, and it's going to be great once we have these stories, the case studies and stories that we can tell. These are built.
Yep, that'll help you sell it. Great. I agree. This is fantastic. Any other comments or questions? All right. Appreciate that. That's a great update. Same team doing this NRES overview, or is it we got a different group?
Yeah, this will be me with potentially some support from others, depending on how deep in the weeds we want to go. So yeah, this we thought it was worth bringing somewhere and landing with the deployment committee as the best place to raise this. We've been financing solar projects through CPACE since the beginning of CPACE. I mean, in the early days, it was 90% of the projects. It's down to around 75% now, but that's still the majority of CPACE projects. And pretty much every single one of them has gone through the old ZREC program, which was the state's primary incentive program for solar, or the successor program, the NRES, the non-residential renewable energy solutions. But we're increasingly seeing interest in the market to do solar projects outside of the NRES program. And as we start to evaluate those, again, we thought it was worth having the discussion with this group about how we're thinking about that. Since we've got so much history of doing them within the program, but with this growing interest, we want to be able to serve the market and hopefully finance projects that are going outside the program. So I wanted to build a framework for how to evaluate those. This interest is coming from primarily 2 areas. One is the NRES program requires you to sell the RECs from the project to the utilities. And many property owners don't want to do that. They want to keep the RECs so they can retire them and count them towards environmental goals or sustainability targets. And Joe, we've been talking with Deep and the state about this as well. There's you can't in many sort of carbon counting or sustainability frameworks, you can't count a project as clean if you sell the RECs. So there's interest in keeping them or selling them into more lucrative markets than what the NRES program is paying now, which actually leads to the second primary reason, which is just the competitiveness of the NRES program. either what you can get for the RECs is less than what you can get in the market, or you just don't even win. I mean, the program is so oversubscribed that many projects just can't move forward. So that's causing a lot of the market to look outside of the NRES program to see if they can get projects done. And it is possible in many cases, but from our perspective, as we think about lending to a property owner who wants to buy one of these solar projects, we need to evaluate them differently to account for the lack of sort of two key guaranteed revenue streams. So NRES, you get two primary benefits when you go through that program. You have a off-taker, the utility for the electricity. So you get a 20-year contract for the sale of electricity, and for a 20-year contract for the sale of RECs. That can be done in two ways: through a buy-all tariff where you're bundling those together for one price for 20 years, or through essentially net metering, so that means you're able to bank, you use the electricity, which you can't use, you bank at your retail rate and get a credit, and then you have a separate 20-year contract for the REC purchase. So how do you think about a project when you don't have those two guaranteed offtake takers, or those two guaranteed revenue streams? The REC one is fairly straightforward. There's a robust state and regional market for RECs, so we can we can look at what the sort of projected 5-10 year value for those RECs is projected to be. We're very conservative with what we'll allow for as we evaluate these projects. As for what those numbers can be, just because guessing REC prices 10 years from now is pretty tough. So we're very conservative there. The electricity side is a little more complicated, and that's where it really comes down to site by site and whether it's possible to do a project outside of NRES. And if you move to the next slide, talk through how this works. So, obviously solar, the sun only shines through part of the day. So the system is only producing for a portion of the day, which you see represented here by the yellow line that's flat at 0 in the early hours of the day, goes up as the sun is shining, and then as the sun goes down, it's producing nothing. The orange line is the electricity, the demand profile of the building. So that's how much electricity it takes. This is just a sort of a hypothetical example. This is how much electricity that the building needs to do whatever it is it does, a school, a manufacturing facility. And as you can see, that demand doesn't align perfectly with the solar production. Many times the day, it's above what the solar is producing. So you need electricity from the utility to make up for the deficit there. And then for a few hours of the day, the solar is overproducing. When you're in NRES, how these two lines align doesn't really matter, because when you're producing more solar than you need, you're able to bank the credit. You have net metering if you've got a netting tariff, or if you've got a buy-all, you're just selling it directly to the utility at a fixed price. So it doesn't really matter how the timing of these two lines line up. However, if you're not participating in NRES, you do not have the ability to bank the credits for in that sort of period of time where the solar is higher than your building demand. So at that point in time, you're just selling the electricity to the grid at whatever the wholesale rate is. You're really no different than any sort of merchant power, natural gas power plant or something like that. So when we look at projects that aren't participating in NRES, we have to really dive down into the expected solar production profile of the project we're underwriting, and then compare that to the 15-minute interval data for the building, so that we can appropriately value the power. at the right rate. So if, for the times when that yellow line is below the orange line, all the power is used by the building. So they're able to avoid purchasing electricity from the utility. So the value of that power is whatever it costs them to buy electricity from the utility, they're avoiding that purchase. When it goes above, we have to value the power at the wholesale rate. So we've, working with our technical advisor on CPACE, we've developed a methodology to do this analysis for every single project that's brought to us that wants financing outside of NRES. We're requiring interval data, and we're doing the analysis to appropriately value the power and then feed that into the SIR analysis. We put the rec numbers in, that conservative rec assumption that I talked about making, and then put in the economics around the power. So like I said, it is possible. You just have to make sure that you're evaluating the project correctly, especially from it's a little more diligence that you have to do on the electricity side, but we believe that we have the right technical framework in place to do these projects. And, when the SIR is met and all the other we're still doing our typical financial underwriting on the property and the business outside of the project characteristics. So, assuming that underwriting meets our standard guidelines, we believe that these projects are something that we can do from a risk perspective. We believe we're evaluating them appropriately, and are able to serve what is going to become a growing piece of the market. And I think it's a good one for us to serve. We want to have a solution for companies that are trying to do the right thing and meet sustainability targets, and are somewhat impaired by the state's incentive program. So I think it's good for us to have a financial solution for them. So I know that was a lot to throw at you, but as we're looking to, we thought we were going to have one at the board meeting on Friday, but it got delayed. But we do expect to start bringing these to the board early next year. So again, wanted to raise this discussion with y'all, let you know we built this technical underwriting framework for these projects, and just see if there was any concerns or feedback that we should take into account as we evaluate these projects.
Any comments or questions for Mackie? I guess, Mackie, I one quick reaction. I want to think about this a little more, but I think it's fascinating that the economics for solar can potentially work. That, in other words, without incentives, or at least state or pure incentives, that there's enough here to make some of these projects work. So that's kind of encouraging, and I guess that's a reflection of costs coming down, and depending on the structure of their rates, there's enough here to make some of these projects economic for the property owners.
Yeah, I guess it's one of the few positive things from our high electricity rates that you can in some cases make solar work without any state incentive.
Yeah, that was my just one question, and you might have sort of mentioned this, and I just missed it. But in thinking about how you're forecast, if there's no like fixed offtake, how you're forecasting future rates as part of your underwriting.
Yep, great question. So that now we're dealing with two rates. Typically, when we think about at least a net metering project, it's just the retail rate that we're dealing with. And in that case, we're assuming a 3% annual escalator on that retail rate. Now, when you're evaluating these projects, not only do you have the retail rate, but if they, for when the production exceeds demand and you're selling at the wholesale rate, you've got to value that appropriately. So we're using, I believe we got VJ from DNV on. VJ, I think we're using a 3% escalator based on the research into the sort of those historic patterns as well. It's either 2 or 3%. Can you correct me if I'm wrong?
It's 3%.
Yeah.
It's the same escalator. And the starting point is the average over the last few, I think it was 10 years. So I think it was 4.5 cents is the current average that we found when we did our regression.
And one thing to keep in mind, Mackie, and I'm sure you're plugged into this, but you know, there's a back and forth conversation around time of use rates and some other changes to the rate structure that you'd have to, you know, continue to pay attention to that might make this even better or potentially harm your economics.
Yeah. Certainly, a minimum it'll make it more complicated, but
Yeah,
we'll stay on top
absolutely
of
more
it. Yep.
complicated.
But that's good. I mean, that's something I think the market's needed for sending those price signals is important.
Great. All right, any other comments or questions?
Well, great. Again, thanks for bearing with us through that. We're hoping to start bringing projects, as I said, forward early next year. So you'll should be seeing that soon.
Look forward to it. All right, are we at the end of the agenda or do we have another item? It looks like I see adjourn. It looks like we are at the end. Brian, anything you want to wrap up with?
No, that's it. Just a quick comment on how excited all of these new developments are in multifamily affordable housing and non-NRES. On the latter, trying to get to an open market solution is super exciting. That's really where we're transforming markets. Under the realization that we have high electric rates, but we're also trying to deal with a mature market to install these systems and get to a levelized cost of energy of solar that's competitive with the grid. So all of that's super exciting. And then the affordable housing stuff, I think we're all sensing just a big kudos to the team for working across agency and trying to figure this out. This is the hardest problem I think that we've had to figure out as an organization. And I think we're all with you, Matt. Like, these are the sorts of things we should be digging into and trying to figure out. And that portfolio is fantastic. As I tell Mackie, I'm super excited to see how the level of innovation that happens with master metered projects, because how they're choosing to invest the present value of those future tariff savings in different things, bringing value today to those tenants is going to be fun to watch. We're really using finance as a tool to bring value to people today, and it's just super exciting to see where the team is. So optimistic.
Yep. I agree as well. All right, so I guess we need a motion to adjourn.
So moved.
So moved. All right, I will second that one. Thank you, everybody, for your time and super interesting information. Appreciate it.
Thank you.
Thanks.
Thank
Take care.
you all.